What's up guys, welcome back to another video, and in today's video I wanted to go over the top 5 day trading concepts that I would dedicate all of my time to learning in the beginning if I were to start over as a day trader. Now, as I build out this channel with more content, I really want to be focusing on more education. And it's not just going to be any education or any types of education. I really want to be focusing on topics that if I had learned in the beginning at a very fundamental level would have saved me a lot of time and a lot of headaches. So that's going to be my primary goal, and that's why I wanted to focus on these top 5 concepts, because if I learned these and really dedicated some time to learning these and mastering these in the beginning, I think it would have saved me months of headaches. So let's go ahead and get started. So the first topic I really want to focus on is liquidity, and more specifically the draw on liquidity. Now, the reason why I want to be focusing on this is because ultimately liquidity drives the markets. And in this context, when I talk about liquidity, I'm going to be referring to areas where there's high numbers of buy orders and sell orders. And more specifically, I'm going to be referring to buy side liquidity and sell side liquidity. So jumping right into it, where does this liquidity rest? Typically, liquidity is going to be resting at swing highs or swing lows, as well as equal highs and equal lows. So like right here, we have a swing high, we have a swing low, we have another swing high right here, swing lows right here, right? So these are areas where there will be existing orders, buy side or sell side, that we referred to as liquidity. So this right here will be considered buy side liquidity. This will be down here will be called sell side liquidity. And the same goes for these. So why are they called buy side liquidity and sell side liquidity? So I'll start with buy side. So buy side liquidity is called buy side because we have a bunch of people or retail traders that are thinking that this is some sort of resistance. So they're gonna try and short this, and they wanna put their buy stops at the top of this range just in case that they're wrong, right? So we have short traders going short here, trying to catch this move down. But we also have breakout traders here that are setting up their buy orders to play the breakout, which means that there's a high amount or a large amount of buy side orders or buy orders here waiting to be hunted. So it's the same for sell side liquidity. You have a bunch of retail traders that view this level as support and want to set their stop losses to play the upside. So they put their stop losses below this level or at around this level to play the upside. And then you also have breakout traders that want to go short here that are also placing their sell orders here as well, which is why it's called sell side liquidity. So why is this important? This is important because the market moves for 3 reasons typically. It's to hunt liquidity, to rebalance inefficiencies or imbalances in the market, or to rebalance to equilibrium. And in this case, you can use these swing points as targets because you know that the market wants to target and hunt these points of interest. So you can use them as targets, but you can also use them as reaction points. You can see what happens when the market hits these areas and then form a trade off of that. So you can see up here at this buy side liquidity level, you see that price hits it, trades through it, wicks it, and then reacts back down to the downside. As well as here, you see price hunts this liquidity, the sell side liquidity, the swing point, wicks through it, and then reacts back up to the upside. So you can use these as a framework. You can use these as a guiding light for when you trade. And more specifically, you can use these as what's called a draw on liquidity. So the draw on liquidity is where price wants to head over to next. And if you can form a draw on liquidity and a bias off of that draw on liquidity, especially off of a higher time frame, it'll help you frame your trades correctly and allow you to stay on the right side of the market so that you have a higher chance and a higher probability of actually winning your trades. So make sure that before you actually start trading and enter a trade, make sure that you understand where price is trying to go, right? And basing it off of these concepts of liquidity and the draw on liquidity, you can do that with much more confidence, knowing where liquidity likes to rest. And the great part about this is that you can actually apply this to any time frame. So typically I like to start on the higher time frames, like the daily, the weekly, just so that I have an overall understanding of order flow and I have a better understanding of where price is trying to target on a macro level. But when you're intraday trading, you can go in on the hourly, you can find swing points where you think liquidity is going to be resting. So it could be something like up here, just for example. You can jump to the 5-minute and start looking for swing points, right? Like if you're bearish, let's say, you could be aiming for this down here, and this could be your sell side liquidity. So it doesn't matter what time frame you're on, as long as you start from the top and work your way down, you can really figure out where price is trying to go next, and then you can start working your trades in that direction. It doesn't mean you have to hold necessarily to that full range, to that full external liquidity that you set up on the daily, but it's basically acting as a compass so that if you do set up a trade and you are bullish, you can hit your bullish targets on lower time frames with a higher probability. So that leads me to topic number 2, which is aligning your lower time frame trades with your higher time frame draw on liquidity. So when I first started trading, I would jump into a lot of trades just because I saw an entry pattern, and obviously I would end up losing a lot and just wasn't really going anywhere. It wasn't until I actually started to figure out what my higher time frame draw on liquidity was and setting up my trades, my lower time frame trades with my higher time frame draw, did I actually start winning more of my trades. So before you even jump into a trade, you need to make sure that you zoom out, preferably to the weekly or daily, and then start framing your trades from there. Because if you don't understand what higher time frame order flow looks like, you're not going to be able to stay on the right side of the market with a high probability. So it doesn't mean that you can't necessarily trade the opposite way. It just means that you're not going to have a higher probability of winning large expansion moves. You're probably going to be trading or have to trade quick scalps or even small retracement moves if you want to win your trades. I like to trade expansion moves because they're higher probability and they're just larger moves. So I like to make sure that my draw on liquidity on the higher time frames align with my lower time frames when I start to look for a trade. So topic number 3 is understanding the relationship between time and price, and understanding when to trade and when not to trade, especially around news. So when I first started trading, I used to trade whenever I could, right? The futures markets were open 23 hours basically, and I just thought that the more time I had in the markets basically meant that I had more opportunities to make money. Long story short, didn't really work out very well. I tried to trade Asia sessions. I even stayed up kind of late to trade London sessions. And it just turns out that price barely moves, especially in Asia sessions, and in London, it's a lot slower. And they kind of have their different patterns compared to New York. So I would normally just end up getting chopped up or was in a trade for break even or something, right? It just wasn't really worth the time trading those sessions. So make sure that you're aligned with time and understand how time affects price. So I would highly suggest you guys to go and trade within the proper sessions and the proper kill zones specifically. And it's because within these kill zones, you have higher volatility and higher volume being traded. What that means is that you'll have a higher probability of your trades working out, you have higher probability of expansive moves, which are obviously good because they're expansive moves and they're not chop, right? So you have a higher chance of actually winning your trades rather than getting chopped up or having it do something completely irrational just because there wasn't enough volatility or enough volume being traded. So my personal favorite kill zones are the London kill zones and the New York AM kill zones. So London is normally from 2 to 5 a.m. Eastern, and New York AM is around 8:30 to 11. I primarily trade the New York. Sometimes if I see something on London and I'm up late, I will try to trade it, but I've kind of shied away from doing that recently because I just haven't been really winning too much, and I don't really see the moves that I want to see. So New York is primarily what I focus on. Even the PM sessions, sometimes I will go and find a trade if there's nothing happening within the AM sessions. Typically you'll see some more movement in the PM sessions. Now, the next thing I really want to focus on within this topic is trading around news. So you really have to be aware of the economic calendar when you're trading futures or just in general trading. You need to be aware of when high impact news is being released. You have to be aware of what type of news it is, what day of the week it's being released. There's a lot of things that you have to be aware of because they inject a lot of volatility into the market at those specific hours. And if you're stuck in a trade and you aren't aware of it, it could stop you out depending on what type of news it is or how volatile it is. So rule of thumb, especially for beginners and for new traders is trade either before or trade after. So if there's 8:30 news coming out, you can trade either before, which I honestly don't suggest. I would probably just wait until afterwards. And then same with 10 a.m. news. You can trade before, but you gotta have caution. You gotta be aware of where time is or what time it is, and just watch that price action. I would highly suggest waiting until after 10 a.m. to find higher probability moves, but that's just rule of thumb. And then in general, the types of news you want to be avoiding are things like CPI, NFP, FOMC. Like those are the big three, in my opinion, that inject a ton of volatility into the market and can basically sweep both buy side and sell side at the same time before actually proceeding with where it wants to go. So I would honestly just avoid those days if you're a beginner. I would just maybe paper trade or just tape read just to see what happens when those news are released. And then once you get more experience and you understand, how things how the market reacts when news like this is released, you can start to trade maybe afterwards, after the news is released and you've seen how the market has reacted. So I'm gonna go ahead and drag this up here just so you guys can see, right? So here is the economic calendar for this week. As you can see, we have quite a bit, right? We had CPI come out today, which is March 12th. I didn't trade it, and you guys can see down here. This candle right here was CPI. Like you can see how volatile that candle is. And trading that it's just, if you're experienced enough, sure, go ahead. But the chances of you getting stopped out are probably pretty high if you don't know what you're doing. So I completely avoided that. I waited a few minutes after to try and trade what was the true expansion move, right? Swept some sell side and reacted back up. Now, Wednesday, we have the 30-year bond auction. That's towards the PM session. PPI coming out on Thursday. Unemployment claims. So these are some pretty decent high impact news that I would definitely keep in mind when I'm trading and making sure that I'm aware of when it's coming out and knowing how to trade it, knowing when to trade it, If you're not comfortable, don't even try to trade it. Just like I said, stay back and watch what happens, and maybe for the future, just keep in mind like how you could possibly trade it going forward. What you guys have to realize is that news, when it comes to news, it's simply just injecting more volatility into the market. It really does not depend on what the results are of the news that's being released. It's literally just going to expedite and accelerate where the market was trying to go in the first place. I think the exceptions would be things like FOMC, NFP, CPI. Those are the big three that I already mentioned. Aside from those, all these other red folder news right here that you guys see here, I think typically will just accelerate price in the direction that it originally wanted to go in. So don't worry about what the news results are. Always just focus on your drawn liquidity, where price is trying to go in that specific moment in time, and trade it that way. And if you were to just tape read this when news comes out, high impact news, you'll typically find that it really just does accelerate price in a direction that it already wanted to go in. So you'll see sometimes price action kind of chop around before, and then once the news hits, it'll just accelerate price in the direction. And you'll start to realize, okay, well, the drawn liquidity was already down there or up there, and when the news dropped, it just boom, it just pushed it towards it. So it's quite interesting, but it's a tip that I never really knew and understood when I first started trading. I always thought, what were the results of unemployment claims? Do we have more unemployment claims reported this quarter or this day? But none of it really matters. It's really just a catalyst for price action if you want to look at it that way. So topic number 4 is going to be about displacement. Now, what is displacement? Let me get rid of that real quick. So displacement is an energetic move in a direction, leaving big bodied candles. So this example right here, this would be considered displacement. So displacement down, displacement up. These are displacing candles right here. Now, why do I want to even be focusing on these, right? If you have displacement, it's a good confluence, it's a good confirmation of trend, in my opinion, right? Especially through swing points. This sell side liquidity right here, we didn't have any displacement down below this sell side liquidity or this swing point right here, right? You didn't have big bodied candles continuing down past the swing point. We basically traded through it, closed above that level, and then displaced up. So what does that tell me? It tells me that we don't want to go down any further, right? This was an actual reversal point. So being able to spot displacement and actually the lack of displacement will help you frame your trades. So in this case, because we didn't have displacement through that swing point, I wouldn't be comfortable looking for shorts anymore, right? Breakout traders could possibly be looking for shorts because they said, hey, like we broke through this level with this support level, game on, we're going to be going down even further just because we had these big bodied candles right before it. But to me, this reaction at the swing point here does not indicate any sign of weakness for me because of the lack of displacement. On the flip side, when you have displacement out of that swing point back to the upside, this gives me confirmation, hey, this is looking very, very strong because of these displacing candles upwards. So that's why displacement is important, which also leads me to topic number 5, which is fair value gaps. Now, what are fair value gaps for those of you that don't know? Fair value gaps are a 3-candle pattern that essentially leaves a literal gap in price, acting as a void of liquidity. So just to make it super clear, what you want to do is find 3 candles, right? So I'll do this candle right here, this big bodied green candle, and then this third candle right here. Between the third candle and the first candle, you have this gap right here. So you want to essentially mark out the first candle's highest point, highest price, and the third candle's lowest price traded. This becomes what is known as a fair value gap. Now, why is this important? Fair value gaps are important because they are voids of liquidity and they need to be rebalanced. And what I've said before is that the market likes to move for three reasons. It's to hunt liquidity, to rebalance inefficiencies in the market, and to rebalance to equilibrium. And in this case, a fair value gap is an inefficiency in the market. So price likes to rebalance these. It likes to trade back into them and then continue on where it originally wanted to go. So you can use these as points of interest to not only take trades off of on the lower time frames, but to truly understand order flow and market structure. So on a higher time frame, you can go and look at fair value gaps that are created and use these as another guiding light to understand where price could potentially want to go. So you can see that we have this third candle right here, this first candle here, creating a fair value gap. Now you see price coming back into trade into this fair value gap and then explode out back to the upside, using this fair value gap as some sort of support, right? So if price ended up disrespecting this fair value gap and actually ended up trading all the way through it and down, you would probably want to switch your bias from bullish to bearish because you completely price disrespected this bullish fair value gap. Because price traded into this bullish fair value gap and reacted back up to the upside, you can stay fairly confident that order flow is still bullish and you can start looking for bullish or for longs. So that's why fair value gaps are important. When I first started, I really just looked for the 3 candle pattern and just took trades off of them wherever I could find them without any actual context, and that got me into a lot of trouble. So I wish I had learned about fair value gaps at a fundamental level and how you can use them to frame your trades from a higher time frame all the way back down to lower time frames, and use them together. If I had learned how to do that from the beginning, it would have saved me a lot of money, a lot of headaches, and it would have helped me expand and level up as a trader. So use fair value gaps, knowing that if they get respected or disrespected can be an indicator of order flow, and also understand that price likes to find these fair value gaps and trade back into them before continuing on its original path. So there you have it, you guys. Those are my top 5 day trading concepts that I wish I had learned from the very beginning. And if I could start over today, what I would primarily focus on until I get a very, very fundamental and firm grasp on what they are and what they mean and how I can apply them to my day trading. So if you have any questions, make sure to leave a comment. Tell me what you guys think. And if you like the video, make sure you like the video and subscribe to the channel for more content like this. But in the meantime, good luck, you guys, and I will see you guys next time.